$11 billion fraud. WorldCom $11 billion fake. WorldCom didn't just fail. It lied. For years, it looked like one of the most powerful telecom companies in America. Huge network, huge reputation, huge investor confidence. It looked safe. It looked profitable. It looked unstoppable. But behind that image was a business under pressure. Growth was slowing. Competition was rising. The real numbers were getting worse. And instead of telling the truth, WorldCom changed the numbers. That decision turned one of the biggest telecom companies in the world into one of the biggest accounting frauds in corporate history. This is the collapse of WorldCom. In the 1990s, WorldCom grew fast. Telecom was booming. The internet was expanding. Data traffic was exploding. WorldCom wanted to dominate that world. The company grew through aggressive expansion and major acquisitions. To Wall Street, that looked exciting. Big growth stories attract money. Big promises attract belief. And WorldCom knew how to sell that belief. It became one of the biggest long-distance and communications companies in the world. That size mattered. Because when a company becomes big enough, people stop questioning it as much. Success creates trust. Trust reduces scrutiny. And reduced scrutiny gives management more room to hide weakness. That weakness was coming. The telecom boom did not last forever. Competition got tougher. Pricing pressure increased. Growth became harder. WorldCom's business started weakening. This is where many collapses begin. Not when the company is already dead, but when the real business can no longer support the image being sold to investors. At that moment, leadership has two choices: tell the truth or protect the story. Telling the truth hurts. The stock can fall. Investors get angry. Analysts turn negative. Executives look weak. Protecting the story feels easier. Just survive one more quarter. Just smooth the numbers. Just buy time. That is how fraud often starts. Not always with some giant master plan. Sometimes it starts with fear. Fear of missing targets. Fear of disappointing Wall Street. Fear of watching the stock collapse. WorldCom chose the wrong path. Instead of admitting the business was weakening, it manipulated the accounting. And the core trick was surprisingly simple. WorldCom took ordinary business expenses and treated them like assets. Here is the simple version. An expense is supposed to reduce profit now. It shows the cost of running the business now. But an asset gets treated differently. It can be spread over time. So if you take a normal expense and pretend it is an asset, the company suddenly looks more profitable today. That is what WorldCom did. It moved costs off the income statement and onto the balance sheet. Costs that should have reduced profit immediately were hidden in a different bucket. That one move changed the picture. A struggling business suddenly looked profitable. A weakening company suddenly looked stable. A bad quarter suddenly looked acceptable. But none of it was real. WorldCom did not fix the business. It fixed the appearance of the business. And that is the heart of the fraud. Real improvement creates real strength. Fake accounting creates fake comfort. For a while, fake comfort can look convincing. Quarter after quarter, WorldCom reported numbers that kept the story alive. Investors saw profits. The market saw stability. The public saw a company that still looked strong. But underneath, the real business was weaker than the report suggested. That gap between appearance and reality is where corporate collapse lives. The outside story says one thing. The underlying truth says another. And management keeps trying to hold those two worlds together. But fraud rarely stays small. Once you fake one quarter, the next quarter becomes harder. Then the next one gets harder too. Because if the real business does not improve, the lie has to keep growing. That is what makes fraud a trap. At first, management thinks it is buying time. Later, it is protecting earlier lies. Eventually, it is no longer reporting performance. It is manufacturing it. That is what WorldCom became. A company trying to preserve the illusion of strength while reality kept getting worse. And fake strength has a weakness. It does not create cash. It does not improve operations. It does not solve competition. It only delays recognition. That delay can feel useful in the short term, but it makes the final collapse worse. Because every fake quarter widens the gap between truth and fiction. Every false report makes the eventual exposure more violent. This is why WorldCom was not just an accounting story. It was also a psychology story. Executives were under pressure. Public companies live under pressure. Miss expectations and the market punishes you. Admit weakness and confidence drops. That pressure can corrupt judgment. Leadership starts thinking, maybe next quarter will improve. Maybe the market will recover. Maybe nobody will notice. Maybe we can fix it later. Those are dangerous thoughts, because later rarely comes. A weak business does not become strong because numbers were moved around. Reality does not disappear because a spreadsheet was edited. And once a deception machine starts running inside a large company, more people get trapped in it. Some stay silent. Some rationalize. Some look away. But silence does not save a company. It poisons it. That is what happened at WorldCom. The illusion held long enough to keep the company looking stable from the outside. But false reporting cannot last forever. Eventually, someone looks closely enough. Eventually, the math stops making sense. Eventually, the truth comes out. In 2002, WorldCom's fraud began to unravel. An internal audit uncovered the accounting manipulation. And once that happened, everything changed. The scale was massive. More than $11 billion in fraudulent accounting. That was not a small mistake. That was a huge distortion of reality. And once the market understood that, trust vanished. That matters because public companies run on credibility. A business can survive bad quarters. A business can survive industry pressure. But when investors stop believing the numbers, the foundation breaks. Can the company be trusted? Can management be trusted? Can lenders trust the books? Can employees trust leadership? Once those questions hit, collapse accelerates. That is what happened to WorldCom. The stock crashed. Confidence disappeared. The company filed for bankruptcy. And one of the biggest telecom giants in America fell apart. The damage did not stay at the top. Employees lost jobs. Investors lost savings. Careers were destroyed. Families felt the consequences. That is why these stories matter. Corporate fraud is not just a technical accounting issue. It hurts real people. WorldCom looked strong, but the strength was overstated. It looked profitable, but the profits were distorted. It looked stable, but the stability was fake. And once the illusion broke, there was not enough real strength underneath to save it. That is what makes WorldCom such an important collapse. It shows that giant frauds do not always depend on unbelievably complex tricks. Sometimes the fraud is disturbingly simple. Move expenses. Improve the earnings picture. Repeat. That simplicity is exactly why it is dangerous. Inside a giant company, a basic lie can hide for longer than people expect, especially when people want to believe the company is fine. And markets do not just run on facts. They run on stories. WorldCom had a powerful story. Telecom giant, big growth, essential infrastructure, a company tied to the future. That story made people comfortable, and comfort lowers skepticism until the truth breaks through. WorldCom followed a pattern seen again and again in corporate collapse: success, pressure, manipulation, delay, exposure, collapse. that pattern matters more than the industry. Because the same structure appears across different frauds and failures. A company becomes admired. Expectations rise. Reality weakens. Leadership hides the weakness. The gap widens. Then truth arrives all at once. WorldCom did not collapse just because telecom became difficult. It collapsed because leadership chose deception instead of reality. That choice poisoned the company from the inside. And once trust was gone, there was nothing left to hold the story together. That may be the simplest lesson in this entire case. Reality wins. Not immediately, not always quickly, but eventually. You can hide losses for a while. You can protect the stock for a while. You can delay recognition for a while, but you cannot do it forever. WorldCom looked like a telecom empire. It turned out to be one of the biggest fraud cases in corporate history. More than $11 billion in manipulated accounting. A destroyed company. Destroyed trust. And one brutal lesson at the center of it all. WorldCom did not save itself. It delayed exposure. And delay is not survival. It is borrowed time. That is the collapse of WorldCom. And the lesson is simple. You can move expenses. You can fake strength. You can delay reality. But in the end, reality always collects.